Welcome back to your CPA audio refresher. Today we're reviewing the statement of cash flows, one of the highest yield topics on the CPA exam. Every cash flow question begins with one simple question. Did cash actually come in or did cash actually go out? If cash comes in, it's a positive cash flow. If cash goes out, it's a negative cash flow. The statement of cash flows reconciles beginning cash to ending cash using three sections: operating activities, investing activities, and financing activities. Remember the flow: beginning cash plus or minus operating plus or minus investing plus or minus the financing equals ending cash. Let's start with operating activities, or CFO. Think day-to-day business operations. Under the indirect method, which is the method most heavily tested on FAR, we convert accrual net income into actual operating cash. Always begin with net income. Next, add back expenses that reduced net income but did not use cash. These include depreciation, amortization, bad debt expense, pension expense in excess of funding, and losses on asset sales. Now subtract gains because gains increased net income, but the actual cash from selling the asset belongs in investing activities, not operating activities. Next come working capital adjustments. Here's the memory trick that solves most questions. Assets move opposite cash. Liabilities move with cash. If a current asset increases, subtract it because cash was used to acquire more of that asset. If a current asset decreases, add it because less cash is tied up or cash was collected. Think about accounts receivable. If accounts receivable increases, you made sales but haven't collected the cash yet, so subtract the increase. If accounts receivable decreases, customers paid you, so add the decrease. Think about inventory. If inventory increases, cash was spent purchasing inventory, so subtract it. If inventory decreases, less cash is tied up in inventory, so add it. The same rule applies to prepaid expenses and other current assets. Now for current liabilities. If a current liability increases, add it because the company has not yet paid cash. If a current liability decreases, subtract it because cash was used to pay the obligation. Examples include accounts payable, wages payable, taxes payable, and interest payable. Here's the quick review. Increase current assets, subtract. Decrease current assets, add. Increase current liabilities, add. Decrease current liabilities, subtract. Now let's move to investing activities, or CFI. Think buying and selling long-term stuff. Cash inflows include selling equipment, selling investments, and collecting the principal on notes receivable. Remember, only the principal collected belongs in investing activities. Any interest collected belongs in operating activities under generally accepted accounting principles. Cash outflows include purchasing equipment, purchasing investments, and making loans to others. Now for one of the CPA exam's favorite tricks. Suppose equipment is sold. The gain or loss is never the cash flow. It is simply an accounting adjustment. Under the indirect method, subtract a gain from operating activities because it increased net income. Add back a loss because it reduced net income. Then report the entire cash proceeds from selling the asset as an investing cash inflow. Always remember, the gain or loss never equals the cash flow. Now let's discuss financing activities, or CFF. Think about how a company raises money or returns money to owners and creditors. Cash inflows include issuing stock, issuing bonds, borrowing money, and other long-term debt. Cash outflows include repaying debt, paying dividends, and purchasing treasury stock. Remember these four rules. Interest paid equals operating. Interest received equals operating. Dividends received equals operating. Dividends paid equals financing. Remember these rules are specific to generally accepted accounting principles. Now let's discuss non-cash investing and financing activities. These are significant investing or financing transactions that do not involve cash. Since no cash moved, They are not reported in operating, investing, or financing totals. Instead, they are disclosed separately in a footnote or supplemental schedule. Examples include issuing stock to purchase land, acquiring equipment through a capital lease, issuing bonds to purchase a building, converting debt into common stock, or exchanging one non-cash asset for another. Now let's review cash equivalents. Cash equivalents are short-term, highly liquid investments with original maturities of 3 months or less. Examples include treasury bills and money market funds. Since cash equivalents are included with cash, transferring money between cash and cash equivalents is not reported as a cash flow. One more disclosure rule. Under the indirect method, companies disclose the actual cash paid for interest and the actual cash paid for income taxes as supplemental disclosures. Remember, these are supplemental disclosures only. They are not additional operating cash flows. The key word is cash paid, not interest expense or tax expense. Let's finish with the 5-step process for preparing operating activities. Step 1, start with net income. Step 2, add back non-cash expenses. Step 3, add losses and subtract gains. Step 4, adjust current assets and current liabilities using the working capital rules. Step 5, arrive at net cash provided by operating activities. Now for one final rapid-fire review. Operating equals day-to-day business operations. Investing equals buying and selling long-term assets. Financing equals raising money and returning money. Depreciation, add back. Amortization, add back. Losses, add back. Gains, subtract. Increase current assets, subtract. Decrease current assets, add. Increase current liabilities, add. Decrease current liabilities, subtract. Interest paid, operating. Interest received, operating. Dividends received, operating. Dividends paid, financing. Non-cash investing and financing activities, disclose only. And finally, remember the biggest rule for this entire chapter. Statement of cash flows reports cash, not income. Just because something affects net income does not mean it affects cash. Always ask yourself, did cash actually move? If the answer is no, it probably belongs as a non-cash adjustment or a disclosure instead of a cash flow. That one question will help you solve countless statement of cash flow questions on the CPA exam. Good luck, and I'll see you in the next CPA refresher.